Hi, I'm Jessica Amir for the Finance News Network. Joining me now from Centuria Industrial REIT is Trust Manager Ross Lees. Hi Ross, welcome back.
Thanks for having me, Jessica.
So first up, for those new to the company, can you give us an introduction?
Sure, so Centuria Industrial REIT goes by the ticker CIP. It's a portfolio designed to provide income to investors seeking exposure to industrial real estate. We've got a portfolio of 39 assets with a value of $1 billion and a market capitalisation of about $650 million.
Turning to financials now, just give us a snapshot on how FY18's shaping up.
So we're off to a good start in FY18. We've put out our first quarter operating update back in October. We've undertaken a significant amount of leasing in the portfolio. 17.5% of the portfolio has been renewed in FY18. We've invested $120 million into new acquisitions throughout the first quarter. We've improved our portfolio's weighted average lease expiry to 4.8 years and our occupancy to 93.5%.
Thanks Ross. Now to your portfolio in a little bit more detail. Can you give us an update on your properties, where they're located, tell us about them and give us an update on any recent acquisitions?
Sure. So we have 39 assets located throughout Australia and they're really heavily weighted towards the East Coast markets. 87% of our buildings are on the East Coast. And importantly, 68% of those are between the dominant markets of New South Wales and Victoria. Our average property size is about 20,000 square metres, and that positions us really well in the infill markets and close to the highway networks and motorway networks. We want to be connected to ultimately the end user, so we're accommodating our portfolio towards wholesale and retail trade, transport and logistics, manufacturing and the growing e-commerce sector.
And can you tell us about the tenant profile?
Sure, so the tenants that we have are really high quality, albeit we're catering towards the middle bracket of the market at the 20,000 square metre space. We have great credit within our portfolio. So 50% of our portfolio's income comes from our top 10 tenants, but of 5 of those 10 have more than 2 buildings with the fund. The tenants include companies like Woolworths, Visy, Australian Pharmaceutical Industries and the Reject Shop, to name a few.
Now, can you give us an update on your key metrics?
So, as I said, we put out our first quarter operating update. Portfolio occupancy is at 93.5% as at the 31st of October. Our portfolio weighted average lease expiry is moving out to 4.8 years. Our near-term expiry risk for FY18 is down to 3.6%, and we've undertaken record amounts of leasing in the portfolio so far in FY18 and in FY17 past.
And Ross, the market's really competitive, so what are you doing to get that leading edge?
Sure, so we are in a competitive market. The industrial sector is very heavily sought after by institutional and private investors. We're still managing to find very attractive investment opportunities. Just in the first quarter, we've settled on the acquisition of $120 million of assets. That's 3 properties, 2 in Western Australia and 1 in Victoria, and a stake in the Property Link Group. Those assets are all accretive to our underlying portfolio metrics and importantly catering to customers we want to have in our portfolio. In fact, one of those buildings in Western Australia was leased to an existing tenant of ours, and before we settled it we extended the lease by 5 yees.
Last question now Ross, before we let you go, what's your guidance for FY18?
So we've put out distributable earnings guidance for FY18 of 19.5 to 20 cents per unit. And off the back of that, we expect to distribute 19.4 cents per unit. That's showing an underlying distribution yield of about 7.5%. Also important for investors to understand is that we provide predictable distributable income. So we're distributing quarterly, giving our investors their desire for predictable income with the opportunity for capital appreciation.
Fantastic. Well, always a pleasure, Ross Lees. Thanks so much for the update.
Thanks, Jessica.